All right, Rocketella Nation, RT here, and if you're just tuning in, welcome to the only channel where we do not just talk about macro, fundamentals, ratio charts, and market cycles. No. We decode them. We unravel them. We turn all that messy market chaos into clear, fast-moving stories that are actually useful. Forget the Wall Street fluff. Forget the polished nonsense. Forget the people talking for 10 minutes and saying absolutely nothing. Here, we care about one thing: what is really happening under the surface, what is moving gold, commodities, stocks, and where the smart money may be heading next. So, all right, today's idea is a big one, a really big one, because what we may be seeing right now is not just another rotation, not just another quarter-to-quarter market shuffle, but the early stage of a real structural handoff, a handoff from bits to atoms. And that sounds simple, maybe even too simple, but it matters, because for years markets were obsessed with digital winners. Software, platforms, AI narratives, asset-light scale, high margins, low capital intensity, beautiful businesses, no doubt. But now the world may be shifting towards something far more physical, more grounded, more resource-heavy, more real-world. Copper, oil, steel, power, infrastructure, machinery, shipping, construction, materials, the boring stuff, the heavy stuff, the stuff people ignore right until the chart starts going vertical and then suddenly everybody wants in. That stuff. And the first thing most investors miss is the size mismatch, because this is where the whole story starts to make sense. U.S. equities are enormous, absolutely enormous, tens of trillions of dollars. Commodity markets, by comparison, are tiny relative to that capital pool. So when people ask, why do commodities move so violently? Why do they spike so hard, so fast, so aggressively? This is why. You do not need every investor on earth to become a full-blown commodity bull. You do not need some huge global epiphany. No. You just need a small slice of capital, a tiny slice, rotating out of gigantic paper markets and into much smaller physical markets. And when that happens, price does not gently drift higher. It lunges, it gaps, it squeezes. It behaves in a way that looks irrational to people who only understand large, liquid equity markets. But the move is not irrational. The move is structural. It is like trying to push 10,000 people through a one-person revolving door. That is not going to look elegant. That is not going to look smooth. That is going to look chaotic, compressed, emotional, wild. And that is exactly how commodity bull markets often behave. So when people say this move is too fast, too violent, too emotional, too much, what they often miss is that the violence is the logic. Small market, big capital, narrow door. That setup almost guarantees exaggerated price action. Second piece, and this is where it gets even more interesting. Profits in resource businesses are not linear. They are not smooth. They are not some cute little staircase moving higher one step at a time. No. They can go from dull to explosive very, very quickly. Why? It's operating leverage. Think about a miner, an energy producer, an industrial materials company. A lot of their costs are fixed or semi-fixed: labor, equipment, maintenance, transport arrangements, site operations, processing capacity. A lot of those costs do not rise nearly as fast as the commodity price itself. So when the price of oil rises, when copper rises, when gold rises, revenue can start moving much faster than cost. And that gap between revenue growth and cost growth, that is where the fireworks begin. That is why commodity producers can look boring for ages and then suddenly become earnings monsters. not because management turned into geniuses overnight, not because the market suddenly became generous, but because the structure of the business changed with the price. One extra dollar in commodity price can create a completely outsized move in margin, cash flow, and earnings power. And that matters a lot because in inflationary or commodity-driven environments, the average household usually does not feel the upside first. Consumers feel pressure first. Wages tend to lag. People are still adjusting to higher prices, while producers, if they own the right asset base, are already seeing that torque show up in the income statement. So ownership matters. If you own the producers, you may own the leverage. If you are waiting for the broader public to feel good first, you may be late, very late. Okay, so quick pause here. If you are tired of market commentary that sounds fancy but says nothing, that is exactly why Rocketeller exists. We talk macro, fundamentals, ratio charts, and market cycles in plain English, in a way that actually helps you think. No recycled headlines, no fake sophistication, no pretending confusion is intelligence. Because most of the time, markets are not random. They are messy, yes, emotional, yes, but underneath all that, there is usually a structure, a story, a pressure point, a reason money is flowing where it is flowing. And that brings us to the next major shift happening inside the stock market itself. For the last couple of years, the Magnificent Seven basically carried the entire show. They were the story. They were the engine. They were the cleanest expression of capital-light growth, digital dominance, AI excitement, and margin excellence. Great businesses, truly. That part is real. But markets do not reward the same leadership forever. And now, the gap between the Mag 7 and the rest of the market may be starting to narrow. That is important. Really, really important. Because once leadership broadens, the market stops being just a code story and starts becoming an everything else story. And what is the everything else story? Industrials, energy, materials, utilities, construction, transport, manufacturing, grid build-out, real capital expenditure, real physical throughput, real-world bottlenecks. Because sure, ChatGPT might need servers, AI might need chips, fine, but a power grid needs copper, a factory needs steel, a shipyard needs fuel, a construction boom needs cement, diesel, machinery, aggregates, logistics, all of it. So when broader earnings growth begins to spread outside the ultra-capital-light tech winners, commodity demand can start to wake up alongside it. And this is where I think many investors are still mentally trapped in the last cycle. They are still optimized for software scarcity, digital scale, low capital intensity, endless multiple expansion. But the next phase may reward something very different. Physical scarcity, resource ownership, production capacity, supply discipline, hard assets. We spent years optimizing bits. Now the world may need to optimize atoms. And if that is true, then the winners in the next phase may not just be the companies with the best app, the flashiest AI demo, or the coolest wrapper on top of the latest trend. Some of the real winners may be the businesses with the best reserves, the best energy assets, the strongest infrastructure exposure, and the ability to convert higher commodity prices into dramatically higher profit. So the setup is actually pretty clean. Small markets, potentially explosive operating leverage, and broadening demand from a wider part of the economy. Put those three together and you have the ingredients for something powerful, maybe even the early architecture of a commodity supercycle. Not guaranteed, of course not. Nothing is guaranteed. But the structure is there. The logic is there. The setup is there. All right. That is the big picture. So if this helped you see the market more clearly, if it helped connect the dots between macro, commodities, leadership rotation, and the real economy, make sure you follow our work and subscribe to the YouTube channel. And for deeper breakdowns, visit Rocketeller.com. Again, one more time, Rocketeller.com. Stay sharp, stay curious, and I will see you in the next one.